Welcome to Protea Academy. My name is Zane Stevens. I'm the founder of Protea Financial. Let's continue talking about the basics of financials. Today, let's discuss understanding your profit and loss statement. For most business owners, this is the one statement they all want to look at. Doesn't matter if you're running a winery or a service business, selling products online, everybody wants to know what is happening in my profit and loss statement. Am I making a profit? But do you really know how to read a profit and loss statement? Do you understand what the key items are in this statement for you to be able to understand what's going on in your business? First up, revenue. Right at the top, you'll find a revenue line item, which would also be known as sales. This is the total income your business earns before any expenses. If you sell $100,000 worth of product, that's your gross revenue. Some businesses will also list income here, like rental income or interest, but revenue is where your journey begins. You could also see some contra revenue, which is like discounts and refunds, which would then calculate through to net revenue. Revenue is a number that people like. They like to see growth, and they like to establish to make sure it matches what's going on in their head in terms of other platforms they might be looking at. Next up on the profit and loss statement is cost of goods sold. These are the direct costs tied to your product or your service, like raw materials, packaging, and production labor. If you're a winery, that includes grapes, bottles, corks, and vineyard labor that come through when you sell the finished good. The cost of goods sold is reduced from your sales to give you the next line of the profit and loss statement, being the gross profit line. Gross profit tells you how efficiently you're making or delivering what you sell. If your gross profit is shrinking, it may be time to look at your pricing, your suppliers, or your production process. Gross profit is a great line item to review to understand how well you are doing at maximizing your revenue from the product or service that you're offering. For most businesses, there will be an industry standard gross margin, which you should measure your own business against. If you're doing better than it, that is a good sign. If you're doing worse than that, it's not necessarily a bad sign, but it is an indicator to take a look and see if you can make some improvements, either by increasing prices or reducing your cost of goods sold. After gross profit comes operating expenses. Operating expenses are interesting. These are the expenses that you incur to run your business. These are your day-to-day costs that are used to keep your business doors open. There are a couple of main categories, but I like to focus in on two of them, which is your selling expenses and your general administrative costs. Selling expenses include marketing costs, as well as any sales commissions for those products. These are expenses incurred to sell your goods, where cost of goods sold is the cost of the product that is being sold. These are the costs which are directly attributable to you making that sale. The second category is general administrative costs, which are rent, software, and most of the time your employee salaries as well. General administration costs can be split between fixed and variable costs, but a lot of them will be in place and are the basic costs required for you to be in business. Some people will include depreciation and amortization in operating expenses, but I prefer to see them below your operating income line. But depreciation and amortization are non-cash expenses showing wear and tear on equipment at the cost or the cost of intangible assets. Generally speaking, when you buy an asset, something of worth that you'll keep around for a while, you're able to expense the cost of that asset over time rather than at purchase. So it is an effect on your total profit over time, which generally matches how you're using that asset. Operating income is then revenue less cost of goods sold, which equals gross margin. Gross margin less operating expenses gives you operating income. For a lot of businesses, operating income is a clear indicator of how well they are doing. Operating income is also before taking into account any interest costs as well as taxes. It's a key profitability measure that tells you how your core business is performing before considering financial or tax strategies. Below the line, you will find items like other income and expenses. These are things like interest income, loan interest, or gains and losses from selling equipment. You'd also find your foreign exchange differences there as well. This would take you down to what we call net income. At the end of the day, your net income is your bottom line, your actual profit or loss. There's a positive If it is positive, you made money. If it's negative, you lost money. But either way, understanding this helps you make informed decisions going forward. So let's recap. Your profit and loss is broken down into key categories. Revenue, which is your total income, less any contra revenue to give you net income. Your cost of goods sold, when you take revenue, subtract your cost of goods sold, you get your gross profit. Your operating income, which is broken down into selling expenses and general and administrative expenses. Gross profit less operating expenses gives you operating income. And after operating income, you'll get other income and expenses, including financing costs and once-off, which will give you your pre-tax income. And once you remove your taxes, you'll get your net income, which is the true bottom line. Understanding your profit and loss isn't just about compliance, it's about control. It is the starting point in understanding how well your business is doing, and reviewing it on a regular basis will help you better understand your business. If you're not already using a profit and loss to guide your business decision, it's time to start. And if you want a second set of eyes to help interpret your numbers, reach out to your accountant, ask those questions, and be informed about what is going on in your business.